trailing growth over the prior 5 years, you can have companies that are fast growth and cheap. Those would be companies on the top right of that previous exhibit. Fast growing and expensive, that's the top left. Slow growth and cheap, that's the bottom right. And slow growth and expensive, that's the bottom left. And you'll recall that the dots are pretty uniformly distributed across that graph, meaning each of the buckets is comparable in size. Sure, there's more fast growth and expensive and slow growth and cheap than in the mixed bag boxes of fast growth and cheap and slow growth and expensive. But what do we find? We find that the excess returns, and remember, this is going back almost 60 years, the excess returns over and above the broad market for fast growth and cheap are the best of the bunch. What a shocker. Fast growth and expensive does pretty darn well. Fast growth and expensive, if it's expensive and it has empirically rapid growth, it historically does just fine. Now keep in mind, in an efficient market, if the pricing is correct forecast of future growth, all four bars should be right pegged at zero. No excess return on average. They aren't. The market is not entirely efficient. Fast growth in the past tends to presage fast growth in the future. And so fast growth and cheap and fast growth and expensive do very nicely. If it's cheap and it's not fast growth, it actually does okay. The market is pricing those stocks cheap for a reason, but they do okay. Slow growth and expensive, that's 2% worse than any of the other three buckets per annum compounded for 57 years. Wow. That is a huge shortfall. It would leave you less than a 1/3 as wealthy as any of the other buckets, less than a 1/4 as wealthy as the two buckets on the left. Fast growth is good. What a surprise.